Hi, my name is Gavin. I'm a Director of International Trade at Customs Connect Limited. Over the next few minutes, I'm going to discuss how the operation of VAT is going to be affected as a result of Brexit. As you'll be well aware, it's taken us quite a bit of time to get to this position, obviously dating back to the referendum in June 2016. As at the 31st of January 2020, the UK did officially leave the EU. And obviously, at that point in time, we did enter a transitional period, which will come to an end on the 31st of December 2020. However, before we get into the impact of Brexit, let's just recap on where we currently are and how VAT operates as things stand. At present, the main frontier that we have is obviously with the EU, so anything coming in from the rest of the world into the EU would be deemed as an import. Anything within the EU has effectively a free movement, so goods can move freely, unencumbered from any duty liabilities and VAT. The only thing we really have to consider ourselves with is obviously the conditions for zero rating when we move goods between the UK and the Netherlands or Ireland or any other member state, and obviously any statistical reporting that's currently required with regards to the movement of goods around Intrastats and EC sales lists. As a member of the EU, we also get to take advantage of some of the EU simplifications, such as triangulation, call-off stock and distance selling, and I will touch upon these issues in the next few slides. However, as we've mentioned, from 1 January, the transitional period will end and the UK will no longer be a member of the EU, which ultimately means that we will no longer be able to take advantage of those EU simplifications that we've just mentioned. So from there on in, everything that leaves the UK to go to the EU will be an export. An export declaration will have to be made, and anything coming in from the EU will be an import, and a full import declaration will have to be made, and potentially customs duties will be paid on import into the UK, plus customs duties could be payable on import into the EU. Obviously, how the UK trades with the rest of the world will remain as before. There is some good news coming out of this, and this is with regards to how import VAT is accounted for. Currently, import VAT has to be paid as the goods are imported into the EU, along with the customs duty. This can sometimes cause fairly lengthy cash flow delays in terms of when that import VAT can be recovered, because you have to wait for effectively the C79 to be issued, which then goes onto your UK VAT return, which can ultimately lead to obviously at least a 3-month delay in receiving your import VAT. However, as of 1 January, what the government did announce is that businesses can use the postponed VAT accounting, which will allow all import VAT to effectively be accounted for on the VAT return. And when I say all, this is not just imports coming in from the EU, this will be imports from all over the world. So this is actually a fairly significant cash flow advantage for businesses, because ultimately, as I mentioned, that the VAT can be self-accounted for. It will be placed into box 1 of your VAT return and, subject to your partial exemption position, recovered in full in box 4. Obviously, if you are partially exempt, then there may be a restriction there. But ultimately, for most traders, that should mean a VAT neutral position with regards to the import VAT, saving a fairly substantial cash flow, creating a fairly substantial cash flow advantage. However, one of the key points to watch out for is obviously with regards to how you trade across Europe. We've already mentioned that the movement of goods from the UK into the EU could effectively trigger import VAT and import duty. So where your operating model requires the movement of goods into the EU prior to onward sale to a customer in in the EU, or various customers in the EU, this could lead to a requirement to register for VAT in either a number of member states or at least the member state where you first import the goods into the EU. Now, earlier I did mention the EU simplifications, and I know a lot of my clients already operate and utilize these simplifications. So first of all, call off stock, triangulation, and distance selling, so all three of them, they were actually implemented as part of the EU regulations, really to avoid the need to be registered in other EU member states. So it's trying to keep down the number of VAT registrations that a company has across the EU. And call off stock essentially was where you may move stock over to a customer's premises, say from the UK, moving stock into France or Germany, and ultimately that stock will always be used by that one single customer, but effectively they call it off as and when needed, and effectively you invoice it as and when they use it. Now in those situations, because the place of supply of goods, meaning that obviously they are physically located in the country of your customer, would generally require VAT registration in that country, but the operation of the call-off stock simplification meant that ultimately your client, your customer, could still effectively account for the VAT on your behalf in that member state, thus avoiding the need for a VAT registration. Similar with triangulation, this was typically where you may have you may be buying from a customer, from a supplier in Germany, but selling to a customer in France, and actually the goods would move directly from Germany into France. Now, as a UK business, making that end sale to the French customer, again, the goods would be physically located in France as they're sold, so that could render you liable for registration for VAT in France. However, the triangulation simplification effectively meant that, again, the French customer could account for the VAT on your behalf. So again, it avoided the need for the UK businesses in that triangle to account for VAT in the member state of the customer. Distance selling is slightly different because this actually relates to B2C sales, so where you're selling to a private individual, the actual end consumer. So as a UK business selling, let's say, books or small electrical items into member states via an online platform, then effectively distance selling meant that you could treat the supply as a UK supply, accounting for UK VAT, subject to a certain threshold. And once you've triggered that threshold, then you may have to register for VAT in that particular EU member state where the consumer is located. But if your sales remain below that, then you could avoid the need for a registration in that particular member state. So distance selling was used quite widely for retailers, and at least maintained the number of VAT registrations they had across the EU to a minimum. However, obviously from 1 January, those simplifications do disappear. So that if you are operating call-off stock currently, or triangulation, or even distance selling, then your operation should be reviewed to check whether you do need to register for VAT in the member states of your customers. I've already mentioned there distance sales and the potential requirement for multiple registrations really across the EU. Now, the EU will be introducing an import one-stop shop, but only from 1 July next year, which gives us a bit of a gap at the moment. But actually, that will be quite a good regime, because actually, again, it would potentially allow you to register for VAT at least in one member state, but account for VAT that might be due in other member states on one VAT return. So rather than operating, multiple VAT returns and multiple VAT registrations, so if you are selling to say 10 customers in 10 different member states, you could effectively register in one and account for VAT on that one VAT return for all other 9 member states as well. So that should make life a little bit simpler, but unfortunately that is only coming in from 1 July. Now there is a fairly significant change for transactions the opposite way around, where overseas businesses are selling to consumers here in the UK. And effectively from 1 January, they're doing away with the low value consignment relief and essentially changing the point or changing the tax point of when VAT is due. So it moves from previously when it was due on import, it will now be moved at the point of sale. So ultimately, the overseas seller should become liable for UK VAT effectively immediately. However, where there is an online marketplace involved, so an Amazon and eBay, what this new change does is actually places the onus on that online marketplace to actually account for the UK VAT on behalf of the overseas seller. So essentially in that situation, what you would have is your overseas trader selling the goods to Amazon first before Amazon then sell it on to the private individual. Now that's quite a big shift because essentially it does suggest that the place of supply is always going to be the UK regardless of where the goods are located. So if you are involved in transactions to consumers here in the UK from overseas, then again it's worthwhile just checking how that's going to operate and who's going to be accounting for the VAT on your behalf, or whether you do need to register for VAT. So that's a very quick canter through some of the key issues that are going to affect businesses come 1 January 2021 from a VAT point of view. If you do have any questions, you can contact me at info@customsconnect.co.uk. My name is Gavin Tucker, and thank you for listening.